What's up, everybody? Unless you have just never turned your TV on, have just been in the Bahamas, Florida vacation, haven't paid attention to anything, just relaxing, meditating, or been under a rock, then you probably haven't heard of one of the most historical two-day drops in the stock market because of the Trump administration putting on these extreme tariffs that a lot of people are talking about. So I wanted to give everybody an update. I've spent a ton of time doing some massive research, gathering from all kind of different sources to put this together. And really, I'm going to bring to you a little quick history of tariffs. Then I'm going to go over why people think this tariff strategy is good. And then I'm going to talk about the cons or considerations people don't like about it. And then at the end, I'm going to talk about, in general, my thoughts, give you some positive outlooks of what I'm seeing, but also tell you how we typically manage our client financial plans around this when this type of thing happens. So it's got a lot of great charts. Stick around. We got charts from Carson Wealth Management Group. We got charts from First Trust, LPL Financial, Visual Capitalist Group, a lot of them. So I'm going to go through these. Really great visuals I think you'll like. But the first thing I want to do is say this. I don't know if you guys remember, I put together a video right before the Super Bowl. This is right before the Super Bowl, guys. Take a look at this. This is from Carson Wealth Management, where it talks about when a Philadelphia sports team wins the world championship, we have a panic, a financial panic, a crisis every single time. This goes back to 1910. Literally every single time there's been a craziness happen to the financial markets, and it's happened again. I hate the Philadelphia teams. Do not root for them to win another championship. Is driving too much turmoil. All kidding aside, it's just ironic though. World Series, Super Bowls, what the heck is going on, Philadelphia? Man, all right, so let's get into this. Let's talk about some history of tariffs. All right, so what are tariffs? I got this on the big board here. Taxes or duties imposed on imported goods by a government. Why are they used? The intent's to protect domestic industries, encourage local production, generate government revenue, reduce reliance on foreign goods, and respond to trade policies of other nations. And then what is their potential impact? Tariffs raise prices for consumers, affect trade relationships with other countries, and influence economic growth. So there's a lot of pros that people are talking about, and then there's a lot of cons. I'm going to hit on both of those coming up here. So let's get into this. All right, guys, this chart here, this is the historical, and this is from First Trust. I'm going to close this out up there. But it's talking about import average effective tariff rates going back to 1789, when our first president, George Washington, actually, their administration imposed tariffs. Back then, 12% of it started, went all the way up to 57%. Now, I want you to notice something here. Watch how these rates go up, and then they come crashing down, and then they go up, and they come crashing down. So that's what I'm looking at. So if I blow this up some more, all the way up to 57%, really in 1830s. Then they dropped all the way down to 14% in the 60s, and then back up to 47%. And then right before the Great Depression, they were down to about 5%. Then they went up to a little over 10. But then we had the Smoot-Hawley tariff tax that they thought would help stop the Great Depression, and they raised them up to 25%. And then you can see what happened there. They dropped back down to 7, where we really didn't have much of tariffs at all, 2%, till 2016 when Trump got in the office and started raising tariffs on China. So that's a quick of that. What's interesting here, since 1790, the percentage of revenue, this is also by First Trust. If I pull this up here so you can see that real quick on that. So this is the tariff revenue as a share of total federal receipts since 1789. Got as high as 96%. That was in the 1860s. I'm getting into the Civil War stuff era out there, 59%, and then dropped like a rock after 1913 over there. You can see that because that's when the federal income tax came into play. Then you had the Federal Reserve came into play. All that in there. So we had dropped off a rock, no tariff really revenue in that. Average tariff rates, you can see us up at the top. Prior to all this, about 3.3%. This also is a First Trust chart. And then we've got, whoops, back that up. And then all the way here, India, 17%, China's 7.5%. That's just the basic tariff rates. Now, what we're going to get into is talking about the Trump administration, why they say this is not the case. There's other things besides the basic tariff that's going on, but we'll get into this. So this next chart here is that exports as a share of GDP, also by First Trust. Again, this chart. We only, again, exporting 11%. Our GDP is exports, which is crazy. China's 20. If you look over the far right there, Japan 22, Canada 33, Mexico 36, and Germany 43% in there. It's absolutely insane. Okay, so now this is actually from Bureau of Economic Analysis. This is the government website on here. So this is the real deal on this. What this is showing is our deficit per month. If I scroll over here, this is getting into why the Trump administration and President Trump has really been on this mantra for 40 years, even when he's not in the office. He feels like we're getting ripped off as a nation. We've lost all these manufacturing jobs, manufacturing plants, like 9,000 of them. I think just in the last 20 years, 5 million jobs, all gone overseas. And we're transferring wealth of 100 and roughly billion a month that goes out. We're buying. We're a consumer country. We consume most of our goods and services, and we're bringing a lot of those into the United States and giving our wealth to China, to Vietnam, to Europe, all these different countries, and they're using those dollars and turning around and making themselves better. And the main concern is China. They, according to, I think his name is, I had it written down here, Bob Lighthizer, used to be the trade rep for Trump back in 2016. Largest military in the world, largest navy in the world. They're building nuclear plants everywhere. They're building bases everywhere. They've now, according to him, they've actually got infiltration into Mexico by investing in there to try and, even though there's been tariffs placed on them before, they're trying to divert these goods and services. They were trying to go through Vietnam. That's why the administration slapped a big one there. And then trying to get these products through to the U.S. And the big thing is fentanyl. That's another big one, is according to Bob Lighthizer, that they produce the resources that create fentanyl. And then that fentanyl is getting into the United States through the Mexican border and even Canadian border and killing our citizens. So that's one of their big mantras there, is that's a major reason. They also talk about, even though I showed you those tariff numbers before, is that they have significant trade barriers above that. And a big part of that's 10, 15, 20% value added taxes, which they take that money and they subsidize not only their own manufacturers, labor, keeping labor costs down, auto manufacturers, all that. And they're putting other requirements on our goods not be able to get into these different countries, and specifically China, because China, again, one of the three biggest places we consume from. Mexico's number one, 400 and something billion. China's in the 400 billions, but it's number two, and Canada's number three. So those are our three main focuses. And basically a national security threat. And if you think about it, go back to COVID. And I'm not taking position one way or another. Some things I agree on here and there, but I'm trying to be right down the middle on this and give you the best information I can. But if you think about this, during COVID, all the supply chain pretty much shut down. There were big ships out in California trying to get to the coastline to be able to drop off goods and stuff like that. Or they didn't even have them. They couldn't get them to us. And there was massive panic in the United States, right? Things are shut down. Government's giving out money all over the place to keep things going, etc. But we could not produce certain goods. Like car prices, literally used car prices are skyrocketing because they were available. We couldn't get new cars because they didn't have chips. Computer chips, semiconductors, all that kind of stuff. So just think about that. They're saying like, okay, if we're not manufacturing our own goods and services in the United States, yes. Is it going to cost more initially? Probably. But if we don't have some insurance, again, maybe there's a massive natural disaster in China, in Taiwan, where all the semiconductor and chips are developed, that type of thing, and we can't get to it. Maybe not even a military thing. So wouldn't it make sense to try and drive some of the manufacturing back here as insurance, not only create jobs, and they're saying that they would take this tariff money to use to create the jobs, create manufacturers, all that, to get us like that. So that's national security. Really, number one is to be prepared, not only in a case of a natural disaster, military issues, whatever, to do that. And then you have to say, all right, technology-wise, can we do that? And we'll get into that too. So that's their main mantra there for that, is the deficit is massive at over $1 trillion annually. And I showed you this chart before. I'm not going to get into that. What's interesting here real quick is largest importer partners as a share of overall imports. If we look at this, each state, and I got to show the disclaimer on here for First Trust. But if you look at this real quick, California, Nevada, Florida, looks like Tennessee, I think this is South Carolina, all and some East Coast states here bringing in the most from China, even Wisconsin up here. China importers, all right? And then Mexico along the border makes a lot of sense. Texas, Arizona, New Mexico, all the way up through there, big impacts as far as importing. And then Canada is huge. Look at this, big blue up here in the Canada region. Huge partners, Mexico and Canada. What a lot of people don't know, and I don't know if they're really telling this on TV or not, there's a lot between the U.S., Mexican, Canadian agreement that was created to replace NAFTA. There's a lot of imports that come in to the United States that don't have tariffs on them. There are a lot of things excluded. And then even the administration is saying there's a lot of things that are not going to be taxed, like lumber, semiconductors. There's more things. I think auto parts are not going to be having any extra tariffs on them. And that's a huge part of what our economy needs to produce goods and services, especially housing too, right? This is export partners, so it's opposite, also by First Trust here as well. If you see this below me, I got to show that in there. But Canada, again, huge. We export a lot to Canada, a lot to Mexico. There's, as you can see, very minimal to China. You got down here 12%, Alaska, Washington, which basically states when China says they're going to slap retaliatory tariffs back on us, it's almost like a joke because we don't export because they don't let a lot of our goods and services in there, or we just don't export to them. And again, it gets into labor laws, issues with China and stuff like that. Again, I'm getting this from Bob Lighthizer, the trade representative. He's been in trade for over 40 years and stuff. So that's the big thing. And I thought this was interesting. Top 5 imported products in the United States from the different areas. This also, again, from First Trust. Motor vehicle parts. Number 1 is actually Mexico. That's why I alluded to before. Auto parts are actually exempt for any future taxes, so that's good. Rest of the world, China is a very small part in auto parts. Not a big deal. And actually, I heard, I think it was on CNBC, that President Biden also slapped a 100% tariff on cars made in China and solar panels. He continued some of the Trump tariffs on China after Trump got into office the first 2016 and so forth. Computers are the big thing, China, and then phones right here. That's where the tech stuff is getting hit right now. But this is national security stuff. When you start getting into that here, because crude petroleum, we're getting all that from Canada. We got all the oil shale stuff that we do now in the U.S. And that's part of the positive that the Trump administration is prices of oil are coming down. Drill, baby, drill. They want to get more oil, energy, independent energy, which will drive prices down because oil is virtually about every product you have and make it. So if we're driving prices down, but tariffs rise prices, that helps offset things. Then they're talking about cutting spending in the government. The DOGE, that's the committee with Elon Musk in there, which, again, that's controversial. But they've been able to identify a lot of government waste, and they're trying to shut that down to reduce the spending there. So you got energy prices coming down. This is what they're saying, which you can see, energy prices, lowering spending. You've got an extension of the tax cuts that would help against offsetting higher prices that they just got passed in the Senate, so they got to get it through the House now. But that would lower tax rates for the lower middle class as well. They're actually talking about raising on the higher end tax bracket is what I've heard. So that's to help pay for some of these tax cuts. So essentially, Trump administration is going after the wealthier, if you think about it, in an indirect way by taxing these companies, the products, because that impacts companies' bottom line, which impacts CEOs' income. And those are some of the highest wage earners in the entire country out there. So that trying to take money that way and then turn that into manufacturing jobs in the United States instead of just taxing higher end income wage earners and just giving money to the lower income wage earners. They're trying to do something positive. That's what they're talking about. Let's see, car imports, Mexico, Canada, and the rest of the world. So this has really more to do with Europe. A lot of European cars come in. All right, here's what so we've gone over the positives of what the administration is looking for. See if there's anything else in here I wanted to mention. The other thing, too, is just the impact on families in the United States with all these jobs lost, even though a lot of people are saying that these jobs have gone into service sectors where they're making more money that way. But really, the bottom line is national security, to be able to produce our own goods and services, steel in the United States. Anything we need, military type stuff as well. Phones. I think one big thing I did see, we were out in Arizona recently visiting our daughter, son-in-law, and a future grandbaby on the way. Our first grandchild, baby Charlie, grandson. But Taiwan Semiconductor has agreed to build a massive plant where NVIDIA actually is doing part of their manufacturing of chips there too, in Arizona, just north of the Scottsdale area, Phoenix area, right up to 17 on your way up to Sedona. Absolutely gorgeous place up there, red rocks all the way up to Flagstaff and the Grand Canyon, just north of Scottsdale area. Massive plant going on, big development to be able to produce chips in the United States. That is a national security interest, which we did not have during COVID. And they actually mentioned, this was Bob Lighthizer, former trade rep, that he made the statement about the G7 countries, the big G7, and we, out of all those countries, even though we have one of the largest economies, the largest economy, we have the lowest life expectancy. I never heard that stat before, 78. Everybody else has a higher, and it's probably because they're taking the siestas and stuff like that, and we work like maniacs. I don't know. But anyway, so that's that on that. All right, so let's talk about up here. These are the cons, why people are against this. So there was a study done, and this is by I think it's the Cato group. I apologize. Cato.org. So it's an independent, nonpartisan, funded by grants is my understanding, and they do independent studies, and they looked at tariffs historically. Remember those charts that I showed you? I don't know if I got one here. I'll get to that in a second. But every time you saw large tariffs put on, high rates, why did they come down? They showed historically that it ruined the trade out there, global trade. It created too many barriers, dropped economic production, actually was worse for the country. So that's what they're showing. And what that means is, if you looked at those big drops, it was because every single administration that has put on extreme tariffs like that, they didn't get reelected. Every single one. And you can actually put that to Trump too. He didn't get reelected his second time. President Biden and Vice President Harris came in, but then they went out and Trump's back in. But if you look at all that, they all got ousted, okay? And that's a big point coming up. Number two here for the people against is like, all right, you're trying to get all these plants built and people working within the next, really, the administration's got 2 years, if you think about it, because you got midterm elections. That's one good thing. There's checks and balances with our government. You got 2 years to prove yourself, because if you don't, you got people starting to get moved out of the Congress that are of your group that, on the same side as the president, if you will. So that's where they're saying a lot of these companies are like, I'm just going to wait and see what happens. I'm not going to go start building a plant and producing in the U.S. when all of a sudden President Trump, because he's been flippant sometimes, he'll say this and he pulls stuff off or whatever. How do I know that's going to stick? Therefore, they don't build them to get some assurity. So that would really take CEOs and companies willing to sacrifice some profit and say, you know what? This guy is right in the fact of national security. We need to really try to figure a way out to do production more in the United States in case something does happen. Again, it's not necessarily military, but it could be natural disasters over in Europe. You know, what if there is a meteor or something crazy hits over there? You never know. We got to be ready to produce here in the United States. So they'd have to be willing to do that, even despite this potential 2-year calamity where it doesn't work out. We've got an economic problem that continues to persist. So that's one point. The other thing that they're talking about, and this is, I don't know if this is conspiracy or what, but they're saying, is he trying to purposely crash the market? Now, why would you say that? This is, President Trump posted this on his True Social platform. This is his account. So I'm not pulling this from anywhere else, but and it was because he was repeating some guys that made a post about this, or he actually reposted. And why would you do that? And why are people saying that? The Congressional Budget Office, and this is from the cbo.gov. This is right. You can go right to their website and see this, and look for the budget economic outlook for 2025 and beyond. And if you look at these numbers at the top, this shows the estimated receipts up there, all the way at the top. $5.1 trillion of revenue between taxes, payroll taxes. Hopefully you can see this. Let me blow this down more. Here we go. There's my cursor. Wait. There it is. 2025. 5.16 trillion in taxes, outlays 7 trillion. So that's our deficit, about 1.9 trillion there, guys. But the key numbers you have to look at, and I think this is important for everybody to know, is 4.2 trillion of this is mandatory of our outlays when we get the revenue. That's Social Security, healthcare, Medicare, Medicaid, all that. What's not listed as mandatory, which I find hilarious, not hilarious, but I find interesting, is defense. We're spending only about 900 billion, only 900 billion. But when you compare that to the social programs, 900 billion is just in defense. And then we talk about China having the largest military in the world. And believe me, I do not want conflict. But if somebody's trying to break into your house, you've got the right to protect yourself. 900 billion. But look at the number below that. 952, almost $1 trillion in interest every year. And I go back to, what is this conspiracy that is Trump specifically trying to crash the market? Why? There's literally $9.2 trillion of government debt coming due soon at higher interest rates right now. I don't have all the details, but $6.5 trillion of that comes due by June, as it states. According to Treasury Secretary Scott Bessent, each basis point, which is 1/100th of a percentage, so if you're at 5, go down to 4.99, that's 1/100th of a basis point, saves the government roughly $1 billion in interest. So since the tariffs have been announced, we've gone through from about 4.3% down to, we're at about 3.8, and then they bounce back up again over 4. But that would be about a $30 billion in savings of interest. Are we trying to go lower than 3.89, 3.5 down to 3 or something? That would be a lot. You're talking like almost $100 billion in interest savings. Talking about cutting expenses, deflationary, stuff like that. So what they're saying is he's trying to drive this market down to where you get these lower rates. He's calling for the Fed to lower rates. He wants Federal Reserve Chairman Jerome Powell to lower rates, but he hasn't stepped in. The problem with that, and this is another point that the cons people are saying, is that our economy is doing right now. So we're at about 4.1% unemployment rate, developing a lot of good jobs. There's actually not a lot of people unemployed per se. There's still a decent amount, obviously, but and that goes to the point that if it's strong, why are we trying to do this? Why are we trying to crash things down? But then that's where this little angle here is he trying to purposely do that so we can save on government debt expense. So that's a big deal because we do have $36 trillion in government debt. That's public type stuff. And there's people consider it even way more than that. And the other point about unemployment, and this is a con that has been brought up by analysts, is that even if we want to produce these plants or build these plants and start producing manufacturing stuff in the United States, there are people claiming we don't even have enough people to do that, to take those jobs, even though Trump administration says 80% of engineers are manufactured or employed by manufacturing plants, which would be a huge boon there. We could get more robotics back into the U.S. and all that type of stuff. But that's one thing, is do we have enough employees to be able to get in on these? And the other thing is to say that these people talk about, this is absolutely crazy what he's doing. It's just like off the wall, some of the calculations they came up with. They even put a tariff on 2 tiny remote Antarctic posts populated by penguins. You've probably heard this. And seals, among other obscure places targeted by the Trump administration's new tariffs. It's called the Heard and McDonald Islands, a territory which sits 2,485 miles southwest of Australia, only accessible via 7-day boat trip from Perth, and haven't been visited by humans in almost a decade. So that was actually asked to, I think, one of the trade secretaries. They said they did that because they don't want China trying to find ways of producing goods and services anywhere on any kind of island that they can get to the U.S. So they wanted to make sure they cover, and you can see my doppelganger there. They want to make sure they cover all the islands out there. That's why they jacked them up on Vietnam too, because when Trump put all the tariffs on China originally, they started shifting all their production indirectly through Vietnam as well. So anyway, and then also analysts are projecting like the impact to the company's earnings with these tariffs. This is from LPL Research, our weekly commentary on here. It's talking about Goldman Sachs, who estimates that every 5 points of additional, percentage points, I think is what they're trying to refer to, would be an estimated 1.5% hit to the S&P 500 profits. And they think that seems reasonable. That means a 20% tariff rate, up from 2 to 3%, could cause corporate profits to drop 5% or more. So that's what people are saying. You're going to get these tariffs, going to cut profit of companies, which then could lead layoffs and stuff like that. That also relates to what is the valuation potential of the S&P 500. If you drop right now, the estimated S&P 500, the top 500 stocks in the country, are estimated to be about a $260 to $270 earnings per share in 2025. If these tariffs stick, even at a 20% level, you could see those earnings numbers drop to be 250, 255. And then if you do, what is a reasonable amount somebody's willing to pay, like a multiple of those earnings? Is it 5, 6, 7, 8, 9, 10? Public companies doing well, they typically averages 16, 18, 20, depending on what's going on. If you put an 18 on it, you're talking about an S&P 500 valuation of about 4,500, which is about 10% lower than where it is now. If you put a lower multiple on it, 15, now you're starting to get down even lower. Now we're talking 10, 20% reductions further from where we are. So then that brings in, how do you manage around that? I'm going to get to that in just a minute, but a couple last things. This is from Clearonomics. They put this out, the Consumer Price Index changes, which is the big concern, is right now we're at 2.8%. We got during COVID, we're all the way up to 9% right over here, but then we're down to about 2.8 now. So if we get another bump in interest rate, we could be what's called a stagflation. So you have rising prices, unemployment increasing, people getting laid off, same thing, and you got a stagflation problem. Then what does the Federal Reserve raise rates? So they're stuck. They had to combat inflation from COVID, so they raised rates. They dropped them during COVID to create all the liquidity to help people survive financially. But now you're in a quandary. So that's why people are saying, why? What's going on here? But then some people point out, this is from LPL Research as well, that they would say that over 100 container ships were waiting to arrive at a Southern California ports during COVID, all that stuff. But one can argue that having zero imports is worse than receiving tariffed imports. And I would agree with that. We don't want zero imports, that's for sure. That would be a problem if that's all shut off and it quickly happened with COVID. All right, so let's look at here's some positive thoughts I want to go through with all this. We've talked about pros for what the Trump administration, the cons. We've had some big downturns. We had a nice upside. When the time I'm videotaping this, we had a good upside of the market, and then it came back down during the day, finished negative. But let's look at some future outlooks potentially here. So what happened with tariffs during the first Trump administration? This is by First Trust, again in here. What happened? The S&P 500 index growth of 10,000 and the change in CPI is what this tracks. So this orange line represents CPI. So from the time that Trump imposed tariffs on solar panels and washing machines, the S&P took a little drop even further. Steel and aluminum tariffs go into effect. So you had a drop there. Dropped about not even 5%, somewhere in that range. Not a big drop. Then they turned around and went, even though there was expanding list of products that will be tariffed due to unfair trade practices. So he was on his mantra back here too. Even China imposed retaliatory tariffs right here as well. The CPI started to raise a little bit. Not much. It went from about 2 to about 2.8. That's not much, about a third. So it went up. But then we had Turkey imposing retaliatory tariffs, all this. But then all of a sudden we had a drop. Trump and Xi announced deal to temporarily halt the escalation of tariffs that were expected in January of 2019 because, look, you had the stock market starting to come back down here again. That was down about 10, 15% there. And then it turned around again where they agreed with Mexico and Canada to remove tariffs on steel and aluminum. So that happened here. So that's where you got a flat line, and then tariff or inflation started peaking back up. Overall, we had a spike. We had a drop because of escalation, leveled off. We had some new agreements with Mexico and Canada, and then it went back up again. And the markets went up until COVID started in 2020. So we've had some pattern of this. So we know what to expect. And you get this priced in. If we know it's going to be this 20% range, I already mentioned where kind of fair valuation would be on that. What was interesting is I did go back and look at inflation back in the Smoot-Hawley tax tariff back in 1930. So if we bring this back here, if you look in the upper right corner, when they enacted the tariff in June of 1930, we actually had deflation going on. Now, there was a few things going on back then that are around today, and that is, one, you did not have a Federal Reserve putting in a ton of liquidity into the market back then. You had a lot of bank failures, thousands of bank failures going on. You did not have Medicare. You didn't have Medicaid. There's not a lot of social programs in place to help support pricing, government expenditures, if you will, to help support prices, people buying things and all that. So that could have been part of that, but obviously the trade situation, if unemployment's going down, you've restricted trading, you can't get goods and services bought and exchanged like that. That could be part of it. So you saw this thing with Trump, we had up, but then it went back down again on inflation. So very interesting point there. Some possibly good news from a technical standpoint. This is a great chart by Carson Wealth Management again. Ryan Dietrich, all the way from 1950 to current. What they looked at is the S&P 500 10% drops in 2 days, which we just had. It's very rare. You can see the numbers up here. 1987, 2008, 2020, and now. So 1, 2, 3, 4, 5, 6 times since 1950 it's ever happened. Look to the far right. The average upside in 12 months, 32%, guys. 32% on the market. And I'll talk to you about how we structure client portfolios and try to take potential advantage of this as well. Also, when there is extreme panic, also by Carson Wealth Management, when the volatility index spikes, so it's basically a measure of panic. When people are panicking, sells, options, stuff like that. Anytime it reaches above 50, it's rare, but then showing potentially bullish. There's only one time, and that was 2008, that it did not end up positive 12 months later. The average upside 20% on that over that period of time. And I personally don't think this is an 08. I've heard other people talk about it. It was on CNBC. We haven't heard one person say the market's going to be negative at the end of the year. I think it's just getting over this initial shock And again, this isn't LPL Financial's opinion. This is my opinion on this, not their opinion at all. And we don't, '08 was a different animal. We had bad loans, foreclosures on properties, a credit stuff being hidden in all kind of different avenues, and all kind of stuff going on that was a lot scarier than what's going on right now. Because we've seen, as we've shown before, tariffs that have historically been put on, they don't usually last long. So that's what I'm getting at here. The other thing I want to point out too is, and I pointed this out during COVID, is this is from the Federal Reserve website. And they put out predictions on the Fed funds rate. And this is when COVID was, we were at like 0.1% on the Fed funds rate. And they were saying it would end up at 0.6 in 2023 and 2.5 in the long run. It went to 9. So I don't know everything. These guys don't know everything. We're all trying to make our best guesstimates on this. But just knowing that people that are predicting absolute panic, they don't always get it right. I can tell you a lot of people that I've seen make predictions, especially dire predictions, have never come true. Now, could they? Certainly could. All right. The other big term that gets thrown out right now, which I always love to put this in perspective, is recession. Oh my God, we're going to go into a recession. We're going into a recession, that kind of stuff. Let me come up on this big thing here. So there's my doppelganger again. Recession, to me, from the standpoint that they just harp on it. Depression is what you want to be concerned about. We almost could have had something like that during 2008-09. Could have had in COVID. We had it back in 1929. But what we didn't have in place, again, back in the 30s, didn't have Social Security, didn't have Medicare, didn't have a Federal Reserve flooding the system and all that with money. But recessions are 2 consecutive quarters of a negative GDP. It could be 1, 2, 3, 5, maybe it's 10%. This was the prediction of U.S. government domestic product, GDP numbers back in 2020, that we'd hit like 25.3 trillion. I think it was by the end of now. But we're at almost 30 right now, 30 trillion production. And we were at 20 during COVID. So even if we had a 10% correction in GDP, that's a big number. That is a big number. We'd still be at 27 trillion production, 26 trillion, even if you throw a 25 trillion. That's still more than we had 5 years ago in COVID. So we've grown dramatically on our gross domestic product production in the United States. And to me, I would not be concerned about recessions. Yes, people will lose their jobs. They can, obviously, and that's not good. But there's hope in this, that usually they don't last long at all, especially with all the stuff going on in there. So a couple other positives that I want to throw out. This is by visualcapitalist.com. Make sure you visit them. They got a lot of great charts too. I haven't brought a lot up in here, but this right here, this tariff talk, there are a lot of exemptions of products. I mentioned these before, but semiconductors exempt from tariffs. They don't include the graphic cards like NVIDIA, stuff like that, but a lot of that, I think NVIDIA is going to be producing in the U.S. I could be wrong on that. I have to double check. But those are GPUs essentially to AI infrastructure. However, key goods like copper, pharmaceutical, this is building material right here, big time. That pharmaceuticals, autos, auto parts, already subject to tariffs, along with steel, aluminum, and lumber articles. Energy and certain minerals not available in the U.S. are also exempt from these reciprocal tariffs. So we've got a lot of key goods and services that can be brought into the U.S. that are not going to get hit with that. This is always a great chart to look at. It shows historically markets going all the way back to the 70s and all the way back. We've been through world wars. We've been through pandemics. They always have historically come back. And you just, to me, is that this is a key chart from visualcapitalist.com. And it really goes to the heart of what I think is that, and Nouriel Roubini talked about it. He just made a recent comment. He said, you could even have, this is a positive thing. He was saying you could even have Mickey Mouse running the White House right now. And by the end of the decade, he thinks the technological advances that are going to be made, again, productivity and everything, regardless of what's going on with this terrorist stuff, We could be still sitting at 4%, doubling our GDP growth and still doing great out there because of innovation, because of technology. He also points out, and I've mentioned this before, that Trump doesn't want to see, he's always campaign, if you elect him, your stock or your 401ks are going to drop like crazy. He does not want the stock market to drop. So like I mentioned before, and Rubini said this, you got literally, this is a guy that predicted the 2008 crisis. So he's usually a doom and gloomer, and he's actually being positive. He's got this 2 years. And if things get too hot and heavy and it's going the wrong direction, he may have to de-escalate quick if he wants to have his full Congress in his favor from the standpoint of Republicans on both sides of the House to get anything he wants to get through out there and get lowering the taxes through. So that gives people more money in their pocket if there's going to be more inflation or something temporarily. But the big thing is technology. This is from 2021, the number of patents applied for by different companies, IBM, Sony's, Apple's, all this. We're talking 8,000 in one company. There are people innovating, they're thinking of new ideas and all that out there right now. They're still doing it. And I believe unless you pull out of the soul of us, the human beings, the ability to innovate, being resilient and adaptable in times of crises, and also being charitable in times of crises, that is a tough thing to bet against. And I said that in 2020, and we came out of that, and I believe we'll come out of this as well. But how do you structure your portfolio for this? What do you do? And I'm going to show you right now what we do. Oh, and actually one other big thing. This is huge. This was back in 21 too, I think, that I mentioned, but don't forget about this. It's not being talked about right now, not being talked about a lot right now, but nuclear fusion breakthrough. Scientists generate more power than used to create a reaction, basically recreating the sun ability to create energy. Don't forget about that, because if this can be harnessed, which they've finally got some breakthrough, this would change the world from an energy standpoint dramatically. The cost would go down dramatically. You would see an unbelievable renaissance. Would that be the proper term? Renaissance in the way we live if this could be harnessed. So that could be coming, or you never know. It could be 2 years, 3 years from now, boom. There's people innovating, guys. Don't give up on that. All right, how do we manage this? So let's take a look at what we do for our clients. We got to look through all these major risks when we help people pursue the lifestyle they desire and try to do it the least risk possible out there. So we got to look at liquidity issues, healthcare, disability, taxes, making sure people don't outlive their money, strive to make sure they don't do that. Cost of living increases, inflation, we've been talking about. Protecting principal when necessary, because you got craziness sequences returns right now with the market if you're getting ready to retire, if they own a business, asset protection, and estate planning. So when we look to formulate a financial plan, including investments, try to bring all this together in one plan. And if you want to see how we do it, we give you an upfront consultation. We can talk about things. We'll give you access to the #1 ranked software in the country from a financial planning standpoint. I'll put the notation of how that's ranked down here below as well. But here's what, I'm going to look at investment side. That really had a major impact on me. This guy named Moshe Milveski. You can go to moshemilveski.com. He's a Toronto, actually from Canada. He's a mathematician, finance, wealth management, insurance. But he's got 17 books published, 6 languages, 60 peer-reviewed scholarly papers, in addition to hundreds of popular articles and blog pieces. He's got award-winning author. He's a fintech entrepreneur. He's got a number of U.S. patents. So this guy, computational innovations, this guy is not a slouch, especially in the retirement income space. When you look at the calculations, he was named by Investor Advisor Magazine one of the 35 most influential people in the financial advisory businesses, and received a Lifetime Achievement Award from the retirement income industry. This guy is not a slouch. So basically what he studied is this. He looked at all the stock market pullbacks since 1970 and looked at basically monthly movements of the market. Could be a range from a -20 all the way up to a positive over 16%. and looked at all the frequency of this. And one of the things that comes about, this is from LPL Research, this is a great chart, shows stock market pullbacks. They're pretty common, happen about 3 times every year, between 5 and 10%. Most people don't realize that. And then when you get into corrections, which we're in now, 10 to 20%, those happen about once a year. The average is about 14%. So these things happen just when, right now it's, man, it feels different, right? But it historically is normal about once a year. And this leads to what I'm going to talk about, how we typically structure client investment portfolios. Is he looked at all this and said, what if we could knock off some of the larger losses monthly, but in return for that, you don't have as big as upside. So he said, let's give you a 3 or 5% downside and a 3 or 5% upside, and then compare that to just investing in the stock market and letting it go. What he found was the second strategy, he ran it through different decades from 1970, and over the long period, that second strategy, by reducing some of the bigger losses and sacrificing some of the upside gains, actually outperformed the S&P 500. Again, that's based on his study and what he's shown, he's done, he's got books on it and everything out there. So what we've done is strive to incorporate that. You can't do it exactly, but the theory behind that is, because if you lose, especially if you're going into retirement, if you lose 30% of your money, because right now we're down like 17% from the high, you got to make 43% just to get back even. So what we strive to do is we set up these 4 buckets of money. And this is just an example. So let's just say you had $1 million in an investment, or your liquid assets. You needed $100,000 a year to retire off of. Your current income sources are like $80,000. You got $60,000 in Social Security, you got a pension of $10,000, lifetime annuity, or maybe rental property or something makes $80,000. So you need to supplement by $20,000 a year, say 2%. Even if that was $40,000, say 4% a year. What we strive to do, strive to mimic what Moshe Milevsky is talking about, is we try to put first 10 to 15 years of income in safe investments in retirement. So if you're coming to me and you're 65 or 60, whatever it is, 70, we're striving to give you the first 10 to 15 years of retirement in these first 2 buckets that are in more conservative type investments. We're trying to have really strive to get no loss in that part, this part of the portfolio. So you got enough in bucket 1 that covers you for like the first 7 years, just spending that down or pouring that bucket out. You're taking that out, you're drinking it, if you will, and spending it on whatever you want to do. And then bucket 2 was right there. It's ready to go. It's been preserved. You're going to pour that bucket out. So bucket 1 is pretty conservative investments. It's going to be short-term, lesser interest rates. And then we're trying to make, on this bucket 2 money, trying to make more than bucket 1, but still strive to have it protected so it's ready to go and you finish up bucket 1. And the reason behind this, besides what I talked about before, is that if you look over a 15-year cycle, I think I got this right here. So this is by LPL Financial. And I'll move this up so you can see the disclaimer on this as well. So this is the percentage of time that the S&P rose over various rolling time periods. And if you look right here, 10 years, 92% of the time it's positive. 15, it's 100% positive. So what we're saying there is, if we can build you a portfolio that gives you your first 10, 15 years of incomes where you can put your head on the pillow at night and strive to have that feeling where you can sleep well at night and keep your cortisol levels low, your blood pressure level low. You don't have to worry about all this tariff stuff and everything going on, because I know I've got my next 15 years buttoned up. And then we take the rest of your money and start moving it into growth assets in bucket 3 and 4 that we're striving to earn more than bucket 1 and 2 and be an inflationary hedge over that 15-year cycle. So when you run out of bucket 1 and 2, we're striving to have a larger chunk in buckets 3 and 4 that you're ready to have. And this bucket 3 is going to have similar type strategies like Moshe Milevsky is talking about, where we're striving to give you upside growth. Could be limited in cases, but we're also striving to minimize bigger losses, if that makes sense, in there. And it's all tied 2 stock market type indexes that we're utilizing. And then bucket 4, we're saying, all right, you're probably never going to use that. That's going to be 20 plus years or more or whatever. So we're going to try to find the next Googles, the next Amazons, and some people say, hey, I don't like that. It's like bucket 3. Let's put it in there. Still tied to growth assets, but have levels of protection, typically between 10 and 40% on an annual every 2-year basis that we put in there. So again, striving to keep your blood pressure low, cortisol levels low, and help you get to your goal with the least risk possible. And these can be shifted in all kind of directions in here on that type of stuff. So I use the analogy of you buy a house on a beach, got these massive hurricanes that can come in and flood the heck out of things in. You got these great views. You're sitting up there. You build up a great amount of money, and you're getting ready to retire, enjoy the sunshine. We're trying to give you that layer of protection. A lot of these houses on the beach, they're built on stilts. In case something crazy happens, we got that layer of protection. And then we have these certain strategies. This is the U.S. or the Kentucky Derby. You can see my cursor here. We got a horse you bet on. He's going around the track. He's about 3/4 away through. Now this guy looks like he's tiring out. Can I still make some money if I pull him off the track right now? I might give some of the bigger upside. Yeah, that's the kind of strategy we use where you can pull things off the track. And then the other funny thing is, not funny, but if a horse is going backwards, he's going this way. We strive to have some investments that may give you a chance to earn money on the downside, even if your horse goes crazy and goes backwards. So hopefully that helps out. Appreciate you joining on. Bottom line is, conclusion, short term, pretty neutral on equities. Could have a drop like we talked about. But again, when we set up these type of strategies for our clients, these buckets of money, historically speaking, knock on wood, we've been keeping people pretty calm about things, so they don't have to worry about this stuff that's going on in the stock market short term for people that are in retirement, that type of thing, because we're building these type of portfolios out. And betting on, again, we believe that human innovation, we believe that resiliency, adaptability, and a charitable in a time of distress, you can't bet against that long term. I wouldn't want to bet against it myself. So I continue to believe that. Hopefully this helps you out. Appreciate you joining on it. If you're not a client, want to give us a call, talk about things, feel free to do that. Or if you're not a client and want to get a hold of us, text us 513-657-0989. Email us at william.wilkins@lpl.com or pursuefinancialfreedom.com. You click on that, hit the contact tab, and you can send us a note there. We'll get a hold of you. So we appreciate it. Thanks a ton. Have a great rest of your day, and keep believing out there. Keep the faith.